Imagine having a dependable friend for your retirement savings, one that consistently provides a steady income stream, almost like a reliable paycheck. What if I told you there are financial tools designed specifically to offer that kind of stability and predictability? Investment bonds are essentially loans you make to an entity, like a government or a company. In return for your loan, they promise to pay you interest over a set period and return your original money, known as the principal, when the bond matures. The different types of investment bonds largely depend on who is borrowing your money and for what purpose, each offering unique features for your financial goals. The primary distinctions among bond types come down to the issuer, which dictates the level of risk and, consequently, the potential return. When you buy a government bond, such as a United States Treasury bond or a savings bond, you are lending money to the federal government. These are generally considered very low risk because the government is highly unlikely to default, but they usually offer lower interest rates. Corporate bonds, on the other hand, are issued by companies to raise money for their operations. These carry a higher risk than government bonds because a company's financial health can fluctuate, but they typically offer higher potential returns to compensate for that added risk. Then you have municipal bonds, often called munis, which are issued by state and local governments to fund public projects like schools or roads. A key feature of many municipal bonds is that the interest earned can be exempt from federal, and sometimes state and local, taxes, making them attractive for certain investors. To make these different types of bonds work for you, start by considering your personal financial goals and your comfort with risk. If you are looking for maximum safety and predictable income, government bonds might be a good fit. If you are comfortable with a bit more risk for potentially higher returns, corporate bonds could be an option. For those seeking tax advantages, municipal bonds are definitely worth exploring. It is wise to consider diversifying your bond holdings, meaning you invest in a mix of different types, to help balance risk and return in your overall retirement portfolio. Think about how each bond type aligns with your need for income versus capital preservation. When evaluating bonds, two important terms to understand are credit rating and yield to maturity. A bond's credit rating, provided by agencies like Standard & Poor's or Moody's, is an assessment of the issuer's ability to pay back its debt. A higher credit rating indicates lower risk. Yield to maturity is a more comprehensive measure of the total return you can expect if you hold the bond until it matures, taking into account the interest payments and any difference between the purchase price and the face value. Understanding these details can give you an edge in selecting the right bonds. By understanding the distinct types of investment bonds, you are empowering yourself to make more informed decisions about your retirement savings. Whether you prioritize stability, income, or tax efficiency, there is likely a bond type that fits your needs. This knowledge allows you to build a more resilient and tailored financial plan, helping you feel confident and secure as you navigate your path to and through retirement.